Welcome back to educator.com. Today we're going to go over balance of payments. So let's go right into the lecture here. We're going to define balance of payment accounts, what that actually means here. We're going to differentiate between current account and financial account. And then we're going to revisit the loanable funds model. We're going to review the underlying determinants of international capital flows. We're going to look at these three different things and kind of reconcile three pieces of data regarding GDP, GNP, and the current account. And then finally, we're going to examine if we actually have what we call a global savings glut. So we're going to try to examine the theories that we have here and try to see how that actually plays out with real world data, what's happened in the 2000s. If the loanable funds model, if all these models that we're going through actually work in practice rather than just in theory. All right, so the balance of payments accounts, what is that? It's a summary of a country's transactions with another country. A current account is the balance of payments on goods and services plus net international transfer payments and factor income. So there are three different things. Let's again try to review this because I think if you don't really break down these things individually, it might be a little difficult to comprehend here. First of all, there's the sales and purchases of goods and services. Second, there's the factor income, and then third, international transfer. So these are what comprise the current account. So number one, number two, and number three. So what are these three individual parts that make up the current account? Well, you have payments to foreigners from foreigners, and you have payments to foreigners. Okay, so payments from foreigners in this example here, I threw out a $2 million, and then payments to foreigners is $2.5 million. So when you have the payment from, so you get $2 million in the current account, and then you subtract the payments you're making to foreigners, $2,500,000, then you get a net balance of negative $500,000 on the current account, which if you want to look at this individually, the sales and purchases of goods and services, you're really looking at export and imports. And so in this particular case, there's more imports that are coming in than our exports. So that's the way you kind of tabulate this particular portion of the total. And the next part here is going to be payments from foreigners in regards to factor income. So you have $800,000 coming in, and then payments to foreigners. Payments to foreigners would be $600,000. So any money that is made from foreigners versus any money that's paid out to foreigners living in the United States. So $800,000, and then you subtract $600,000. Again, I'm just using a hypothetical example here, and then you have a net total here of $200,000. Okay, so $500,000 is going out, so you have a deficit in the current account, but then you add $200,000 in, and it lowers the deficit that you have. And then the final one is probably going to be the one that you're not going to get the most data available and probably not the most significant, but there's also international transfers. So these are funds that are sent by residents of one country to residents of another. And let's just say that there was a net $100,000 that flowed out of the country. So you have negative 500,000, and then you have positive 200,000, and then you have negative 100,000 in this particular country here. So how do you calculate the value of the current account? And this is what we have here. So the current account equals the net foreign sales of goods and services plus the net factor income plus the net international transfers. And what we had before here in this hypothetical scenario was negative 500,000, positive 200,000, and then negative 100,000. And if you add these three figures together, you're going to get a net outflow of negative $400,000. So current account deficit is exactly how it sounds. So deficit is when more money is leaving than is coming in, like a budget deficit or trade deficit. So current account deficit is when the value is negative. Now conversely, this should be quite obvious here, but the current account surplus is when this value is positive. Now, what is the biggest component of current account deficit and current account surplus? It's definitely going to be the net foreign sales of goods and services. The United States, we've ran a current account deficit for several years, and it's gone pretty high. So the amount of goods that we actually import greatly exceed the amount of goods that we export as a country. If you look at a country like China, it works the other way around. China tends to export much more than they import. So they have a current account surplus. So again, so if you want to get a crude sense of what a surplus is and what a deficit is going to look like, current account deficit, just think of USA. So imports are going to be greater than the exports. And then you have here, you're going to have a current account surplus. You're dealing more with a country like China where the exports are greater than the imports. Now that being said, is it possible? Is it possible for a country that has more exports than imports to have a current account deficit? It's theoretically possible, but that means the amount of factor income, the number of citizens that are living abroad, making money in other countries, that's going to have to account for a huge portion. Same thing, is it possible for a country whose exports are greater than imports to actually have a current account deficit? Again, that's possible, but that means that the reverse is true. That means that there's going to be a lot of foreigners living within the country, making a lot of money. So imagine if millions of Americans were living in China, and basically the amount of factor income that they're making was such that it outweighed the amount of exports that China was exporting. But again, as a general rule of thumb, if a country is going to import a lot more than they export, then you have a current account surplus, like in China. If you have a country or imports more than it exports, then you're going to have a current account deficit, like in the United States. But if you have a country that is going to export more than it imports, then you have a current account surplus. All right, let's go ahead and take a look at the financial account, and hopefully we're going to be able to tie together how these two accounts actually link together. So the financial account is the difference between a country's sale of assets to foreigners and its purchases of assets from foreigners during a given period. Okay. So official assets and purchases, and you have private sale and purchases of assets. Okay. So payment from foreigners, let's assume it's $500,000, and let's say payment to foreigners is going to be $600,000. So in this case, there's more payments that are going to foreigners than there is coming in from the foreigners. So you have a net value of 100,000, negative 100,000, because it's 500,000 minus 600,000. Now, private sale and purchases of assets. Let's say that payment from foreigners is $600,000, and payment to foreigners is $100,000. So as far as what individuals within the country they're selling, let's say it's Dodger Stadium, for example. Let's say Dodger Stadium is up for sale, and it is purchased from proceeds from a citizen outside the country. Then money is coming in that case. Whereas if payment to foreigners, that would be example of a United States citizen going to Japan and buying property in Japan. If that's the case, if we have a mismatch, then the difference is the net private sale and purchases of assets. In this case, more money is coming in from foreigners. So in this case, it would be 600,000 with $100,000 leaving the United States. So in this instance, the net amount is $500,000. So we would be getting cash, we'd be getting extra money, but we're giving up assets on net. So what is the financial account given these, again, two hypothetical numbers here? You have negative $100,000, which is, again, payment from foreigners minus the payment to foreigners. So you have negative $100,000. And you have positive $500,000. And so the total is going to be $400,000. So the numbers itself aren't necessarily that important. You're not going to get numbers this specific on the AP macro exam. What you're going to have to understand is, what are the components of the financial account? What are the components of the current account, and how do they reconcile? So did you notice anything? So hopefully you noticed the following. The current account, again, the numbers I gave, again, purely hypothetical numbers. The current account numbers totaled negative $400,000. And the financial account equaled $400,000. So hopefully you see that the actual numbers are going to equal each other, except the financial account equals negative current account, or you can look at it as current account equals negative financial account. So that's the one equation here that you might want to commit to memory. Now there are some statistical discrepancies. So when you actually collect the data, you're going to be off by a couple billion, hundreds of billions of dollars. When you're dealing with a country like the United States, where you have trillions of dollars moving in and out, and so you're going to get some statistical discrepancies. But when you're off by only $100 billion, $200, $300 billion, it's actually not that bad. Okay, so what you have is current account equals the financial account. So the current account equals actually the negative financial account. Or if you want to rewrite it in a more clean way, if you want to put all the components on one side and then put 0 on the other side, you have the current account plus the financial account. That equals 0. Or again, as I said, the current account equals the negative financial account, or the financial account equals the negative current account. So the way it works out is the payments to the U.S. for goods and services, factor income and transfers, and you add that to the payments to the United States for its assets, that's going to equal the negative payments to the rest of the world for goods and services, factor income and transfers, and also payments to the rest of the world for assets. So again, this is just another way of rewriting the equation. So just showing that, if money is going in one way, well, and goods are flowing out, then they basically have to balance each other out. So there's no mystery as to why it equals to each other. I guess somewhat similar to the savings equals investment equation. You have this situation where the current account equals the negative financial account. But what exactly is a financial account? A country's financial account, what it does is it measures the net sales of assets such as currencies, securities, and factories to foreigners. Okay, so what does that mean here? These assets are exchanged for financial capital. Measures of capital inflows in the form of foreign savings that become available to finance domestic investment spending. Okay, so foreign savings are what's coming in to be able to finance things that countries that are in a current account deficit are able to do. So basically a country like the United States, where you have this massive current account deficit, basically a lot of the spending really couldn't occur unless another country was kind of financing it. So this is what's meant by a current account deficit and a financial account surplus. So let's tie together the financial account here and revisit this loanable supplies. So the graph of loanable funds here. There's something called foreign direct investment. So there's the idea that foreign direct investment can come in, but let's just assume the following, that all flows come in the form of loans. So purchases of stocks in foreign companies and real estate, as well as foreign direct investment, in which companies build factories or acquire other assets directly. There are ways that money can come in this way, but let's just assume, for the sake of this example, when we're dealing with this, the loanable supplies graph, we'll just assume everything comes in the form of loans. Also, there's impact of exchange rates, but again, for now, we'll discuss exchange rates in the next lecture here. But we're going to ignore the effects of expected changes in the exchange rate for now. So assume that the equilibrium interest rate in the loanable funds model is 4%. So let's say you have this 4% interest rate. Okay, so that is this equilibrium that's going to be the point at which people are going to borrow and lend from. So how would that look here on the loanable funds graph here? So again, you're going to have the interest rate right here. And then again, this is the quantity of loanable funds. And graph this here. You have the demand of loanable funds here. And you have the supply of loanable funds. Let's label this as R. So this is R1 here. And this is Q1 here. And so this R represents 4% here. So again, this is, a review of how the loanable funds graph is going to look like. All right, now let's assume this following situation. So we have this loanable funds model, but what we didn't include was the fact that interest rates are going to vary within countries. And so if that's the case, how does that really change the equation? Okay, so we're going to assume the following here. So assume that the equilibrium interest rate in the United States is 6%, and that in Korea it is 2%. So let's say there is no, there's just two separate interest rates, and what's going to happen if capital is allowed to move freely from one country to another? What will happen? So what's going to happen is there's going to be capital inflow to the United States and capital outflow from Korea. The general rule of thumb is investors prefer higher real interest rates to lower real interest rates. Now, notice I didn't say nominal, because you could get 10% nominal interest rate in one country and you can get 4% nominal, but if there's 1% inflation in the 4% country and there's 30% inflation in the 10% country, then the real interest rate that you're going to get is much better, even though the nominal is lower. So let's assume that this is the equilibrium real interest rate. All right, so this is let's assume that this is the United States here, US here, and on this side is Korea. Okay, so in the US you have the 6% interest rate. So let's go ahead and graph this here. So this is supply of loanable funds here, and this is 6%. This is the R, which is the interest rate. And this is the quantity of loanable funds. Let's draw the same quantity of loanable funds right here, quantity of loanable funds. And this is R, the interest rate again. Now you want to make sure that this is the demand for loanable funds here. Let's put this a little bit lower. Now in Korea, you have the opposite scenario. So let's label it as such. For whatever reason here, the supply of loanable funds, demand for loanable funds, is 2%. So what's going to happen here? There's going to be there's going to be, if you look at these two countries, the US and Korea, would you rather get a 2% return or would you rather get a 6% return? So this is going to be a no-brainer here. So capital is going to flow from South Korea to the United States here. So here is going to represent, this area here is just going to represent capital inflow. And on top right here, this is going to represent capital outflow. Yeah, and this makes sense. If you're in an interest rate environment where the interest rate is 6% and the prevailing interest rate is 2%, then the money is going to flow out of the country where you're only getting 2%, and you're going to go into a country with higher interest rates in the United States. Now, there's going to be different problems with that. If a country then deliberately tries to raise interest rates, well, the problem with doing that is that you're going to hurt the economy, because it's going to be very difficult for citizens to be able to take out loans at such high interest rates. So there's some benefits and there are some drawbacks of having high interest rates. But one of the benefits is that you're attracting a lot of foreign money into your country when interest rates are a little bit higher. So let's take a look at the GDP, the GNP, and the current account and see how they're related to each other. Again, recall the basic equation for national income accounting. Again, if you don't know this by now, commit this to memory. This is going to come up on the AP macro exam. You want to make sure you have this stored away in your head. Y equals C plus I plus G plus NX. Okay? Or if you don't like that NX model, you can look at Y equals C plus I plus G plus X minus IM, which is exports and imports. So again, if that confuses you here, NX equals X minus IM. So either way, so that's the equation for national income accounting. Now, the question here, it's a valid one here. Why doesn't the national income equation use the current account as a whole? And the reason, you take a look at this, GDP is the value of goods and services produced in a country. It does not include international factor income and international transfers. So why isn't that used? Why does GDP only take into account the value of the production of goods and services within a country's borders? Why does it not include factor income? And the reason why is that well, GNP, or gross national product, it does include international factor income and transfers. But why do we use GDP and not GNP? Why is GDP the prevailing figure that we use? The reason being is that the intent was to track production and not income. So yes, the GNP might be a better measure of factor income because that's included in there. But we're more concerned about production rather than the actual income. So GDP does a little bit better job than GNP. But again, it used to be the case that GNP was used more often than GDP. But again, today most economists will point to that GDP figure rather than the GNP. And for practical reasons too. So data on international factor income and transfer payments are generally considered unreliable. Whereas you're dealing with the value of goods and services, all the payments flowing in and out, that can be measured quite easily. And so that's why we tend to use the GDP, and that ends up being a little bit more convenient than the GNP. So this global savings club, what does it mean that there's this global savings club? Well, in the early 21st century, the United States entered into a massive current account deficit. So there was a current account deficit before, meaning that we imported a lot more than we exported, but it became even more pronounced. We had a kind of an interesting situation where our current account deficit kind of exploded in the early 21st century. So again, the U.S. imports more than exports in a given year. Again, that's the biggest chunk out of the current account deficit. So the U.S. takes in a lot of capital inflow from the rest of the world, most notably China. So again, our financial account is going to be, as positive as it is negative in the current account. So again, because they do equal each other. Now, how did this happen here? So there's, again, how it actually happened. There's people that might speculate on certain things. This person who actually made the speculation on this global savings glut had some credibility. You can imagine. He was a Fed governor of the Board of Governors at the time, not the Fed chairman at the time. He was one of the Board of Governors of the Federal Reserve Bank. Later became the chairman. Now he's an ex-chairman. But former Fed chairman Ben Bernanke, in 2005, he was appointed in 2006. A Fed governor at the time said that this global savings glut led to excess investment spending in the United States. Okay, so what is basically being said here is that a lot of countries, they had a lot of money piled up and they had to figure out, okay, where do we put this money in? So even though there are better opportunities elsewhere in theory in terms of higher real interest rates, the United States was seen as kind of a safe haven to put the money into. Now, I don't know where anything would have been safe to hold on to during the financial crisis, but better in the United States than in other countries where there wasn't a lot of confidence in the economy. So again, because of the financial crisis in the late 20th century, other countries found the U.S. as an attractive destination despite low interest rates. So even though Argentina might be giving 10% interest rates, with the history of the country's economic instability, relatively meager 3 or 4% in the United States might actually have been more attractive than the 10%. So the model still is true, the loanable funds model, the idea that higher interest rates will attract more investors. But when you couple this with reality that it's not just the interest rates that countries are looking for, but they're looking for economic stability and political stability as well. So let's take a look at example number 1 here. The balance of payments on the current account plus the balance of payments on the financial account is equal to which of the following? Okay, so again, you want to make sure that you get this here. The current account plus the financial account equals what? And it's a big fat 0 here. So this is going to be the correct answer. Not 1, not the trade balance, not net capital flows or the size of the trade deficit. Or again, the alternate way is the current account or the CA equals the financial account, or the negative financial account, or negative FA. So whichever way makes more sense to you, make sure you memorize it as such. Okay, example number 2. Let's revisit the loanable funds graph here. So on a loanable funds graph, show what would happen if there are capital inflows to a country with a 6% interest rate. When supply increased, what happened to the interest rate? Okay, so let's take a look. So what happened if there's capital inflows here? So maybe supply isn't the best word, but let's say that there's more money. When there's more money that's flowing into supply, it's not the supply curve that's shifting here. It's actually the demand for loanable funds. But let's go ahead and take a look at that of demand for loanable funds right here. So here's the quantity of loanable funds. And here's the supply of loanable funds. And let's say you have the 6% interest rate here. So R, which is the interest rate, the real interest rate. Yeah. So this is Q1 here. Now what's going to happen is that if there is more inflows coming in to the country, the indication is that there is a demand for increase in demand for loanable funds. So for example, when there are capital inflows to the country, what happened to the interest rate actually? Let's take a look at this here. it's not the demand for loanable funds, excuse me here. When the supply actually did increase here. So when there's a supply increase, what happened to the interest rate? So let's say this was the United States here. So let's say in the US, you had a 6% interest rate. Eventually, when there is a capital inflows coming in, when the supply of loanable funds increases, when it actually comes in, it's going to reduce to something like 4% here. Because the supply of loanable funds increases, then you have, 4%. So again, in a country that might have a 2% interest rate, if the supply of loanable funds comes in, then there's going to be an increase in the supply of loanable funds, and you're going to eventually have a reduced interest rate as supply of loanable funds increases to the right. Example number 3 here. Which of the following will increase the demand for loanable funds in a country? So if you remember the lecture on loanable funds, one of the things that would increase the demand for loanable funds would be a budget deficit. So the crowding out effect. So when the government spends more money than it has available from tax revenues, well, it got the source from somewhere. So their demand for loanable funds increase. What's going to happen is interest rates are going to go higher, and private investment is going to be crowded out here. So this isn't talking about the same thing here, but it's basically the same thing that will happen. What is similar to government budget deficit in terms of loanable supplies here? What will increase the demand? Well, a government budget surplus will actually decrease the demand for loanable funds, you can argue. Decrease private savings rate. So that's going to shift the supply of loanable funds to the left. And that's not true. A recession is going to shift the demand for loanable supplies to the left. A decreased investment opportunities, again, that's going to decrease the demand for loanable funds. Economic growth, that's absolutely going to increase the demand for loanable funds in a country. And again, that's going to raise interest rates as a result. So take a look at this quick graph here. So you have SL, DL. When there's an increase in the quantity of loanable funds, the interest rate is going to increase because the demand for loanable funds increases, DL2 here. You're going to go from QL1 to QL2 here, and R1 to R2 here. And again, economic growth is one reason why the demand for loanable funds might shift to the right, as well as a government budget deficit. And finally, let's take a look at this situation here. And again, this actually is something that might happen in the future. Not saying that it will happen, next year or maybe even 5 years from now, but this appears to be something that China is headed for. And so how would that look when you're dealing with current account and financial account here? So suppose China decides to start a huge program of infrastructure spending, which it will finance by borrowing. So let's say it doesn't have the money on its own, so it's going to borrow from other countries here. So how will this program affect the United States balance of payments? Okay. Well, let's assume that the money that would have been flowing into the United States is now being diverted to China, or the fact that make it a point to say maybe it's the U.S. that's helping finance China's infrastructure spending. If that were the case, then how would the current account and financial account be altered? So let's take a look at this here just to give you an idea of not only how to answer this from an economic perspective, but from a test-taking strategy perspective. So how would you be able to answer this here? So A is current account increases, financial account increases. B, current account decreases, financial account decreases. C, current account decreases, financial account increases. D, current account increases, financial account decreases. Or E, none of the above. So let's take a look at this. Even if you covered up this section here, let's say you didn't even read any of this, you know that A and B are absolutely wrong. It cannot be correct. Again, what do we know the equation as being the current account equals the negative financial account. So if one goes up, the other goes down, or conversely, if one goes down, the other goes up. So A and B are just wrong by definition. So you want to make sure, if you have no idea, now you're left to a 33% chance here. Now, none of the above, I guess it is possible that they don't change at all, but this question seems to imply that something's going to increase or decrease. So E, none of the above, we can cross this out here. So even if you didn't really know a whole lot on how to analyze current accounts, just based on knowing the equation, you've narrowed it down to 50-50 shot. And that's a great thing to do here. So if China is going to borrow, then what's going to happen is that money is going to flow into China. And so their financial account is going to increase, and they're going to incur a current account deficit now, or their surplus is going to be reduced. Now, if that's the case, if the financial account is increasing and the current account is reducing, then in the United States, it would be the flip situation. The financial account is reducing and the current account is increasing. So it's not this. This is what's happening in China. But in the United States, presumably, again, a lot of the funds that would be going into the United States, they're being diverted to China. And so the current account is going to increase in the United States, and the financial account is going to decrease. So again, money is now flowing into China rather than to the United States. Again, something that from a practical standpoint, you're probably going to see this happen. Again, we don't know specifically, but if you again see where money flows and you're dealing with where people want to invest money based on interest rates, this is probably the trend that you're going to see. Thank you for watching educator.com.